NVIDIA's recent dip isn't a puzzle, it's a consolidation. This isn't weakness, it's a strategic pause before the next leg up, and a 10% pullback is your chance to get in. For Canadian investors, understanding this brief lull in the AI giant's meteoric rise is crucial for re-evaluating your tech exposure, especially as our domestic markets quietly outperform today. You're on InvestIQ. Today, we're dissecting the real story behind NVIDIA's recent movements, moving past the headlines to give you the InvestIQ perspective. We'll start with why Jim Cramer's perplexity is actually a green light for investors, then dive into the underlying demand that's still fueling the AI engine, and finally, I'll give you a precise number that nobody else is talking about, a crucial metric that shows exactly where NVIDIA is headed next. Let's cut to the chase. Jim Cramer, bless his heart, recently expressed perplexity over NVIDIA's stock action. He wondered if the AI rally was over, if demand was softening. This isn't new. Cramer often gets caught in the emotional whipsaw of market movements. But for the astute investor, Cramer's confusion often signals opportunity. Today, the TSX Composite nudged up 0.3%, with our big banks like Royal Bank and TD Bank seeing healthy gains of 1% and 1.36% respectively. Bitcoin and Ethereum also saw slight upticks, while the S&P 500 and Dow Jones Industrial Average added around 0.4% and 0.3% respectively. This quiet, broad market strength is important context. It tells us the global economy isn't falling apart, and that tech, while volatile, isn't the only game in town. Now, let's talk about NVIDIA. Over the past few weeks, NVIDIA pulled back about 10% from its recent highs. Some analysts immediately screamed, "Bubble burst," and pointed to slowing growth rates. But let's apply some common sense. A stock that has doubled, tripled, even quadrupled in a short period must consolidate. It's not a sign of fundamental weakness, it's the market catching its breath. Think of it like a runner. Even Usain Bolt has to slow down between sprints to regain energy. The underlying demand for AI infrastructure, for those powerful GPUs, hasn't disappeared. It's actually intensifying. We're still in the early innings of this AI revolution. Every major tech company, every cloud provider, every enterprise looking to leverage AI capabilities, needs NVIDIA's hardware. The spending on AI infrastructure isn't discretionary anymore, it's foundational. Consider this, enterprise adoption of AI tools is still in its infancy. Companies are just beginning to understand how to integrate large language models and advanced analytics into their operations. This requires massive computational power. And right now, NVIDIA is the undisputed leader in providing that power. Their competitive moat, built on decades of R&D and a robust software ecosystem like CUDA, is formidable. We're not talking about a flash-in-the-pan trend. We're talking about a fundamental shift in how businesses operate, how research is conducted, and how data is processed. This isn't a nice-to-have, it's a must-have. So, when you see a 10% dip in a market leader, don't panic. Look for the underlying drivers. Now, let's address the strongest counterargument. Skeptics will argue that competition is heating up. AMD is pushing hard with its MI300X chips. Intel is trying to re-enter the game. Even companies like Google and Amazon are developing their own custom AI accelerators. And yes, competition is real. It's a valid concern. But here's why it doesn't fundamentally shake NVIDIA's long-term thesis: market share. NVIDIA isn't just selling chips, they're selling an ecosystem. CUDA, their proprietary software platform, is deeply embedded across the AI development landscape. Developers are trained on it. Models are built on it. Switching costs are incredibly high. It's like trying to get everyone to switch from Windows to Linux overnight. It's not impossible, but it's a massive undertaking. NVIDIA has a multi-year head start, and their innovation engine isn't slowing down. They're constantly pushing the boundaries of what's possible, releasing new architectures and improving performance. So, what's the concrete takeaway for you, the Canadian investor? This 10% pullback in NVIDIA isn't a warning sign, it's a strategic entry point for investors who missed the initial run or want to add to their positions. But here's the number nobody's printed yet, the one that tells you exactly where we're going. NVIDIA's forward P/E ratio, after this pullback, is sitting at roughly 35x for the next 12 months. Now, compare that to its projected revenue growth, which is still comfortably in the 20 to 30% range for the next few years, and its historical average P/E during periods of high growth. A forward P/E of 35x for a company growing at 25% plus in a foundational industry is not expensive. It's reasonable. And when you factor in the sheer size of the AI market opportunity, and NVIDIA's dominant position within it, that 35x looks like a bargain in disguise. This isn't about chasing headlines. It's about understanding the fundamentals, separating the signal from the noise, and recognizing that healthy consolidation is part of any strong growth story. So, while Cramer might be scratching his head, you should be looking at NVIDIA's recent dip as an opportunity. That's the InvestIQ take for today. Analysis only, not financial advice.